Okay, just check you guys can hear all right. Is the sound okay over here? Yeah, nod. Good, good. You guys up back, you okay for sound? Good. You guys okay for sound? And presume you guys in the middle are okay? Good. Good. Let's see what the time's doing. I suppose I got 1 minute before it goes. Right, okay, so now got 1 o'clock, so we'll make a start. Just to review what we did yesterday, we started off when we were talking about the foreign exchange market. So we motivated why we have them, or another way of saying it, what the economic purpose of foreign exchange market is. It's to trade your domestic currency for some foreign currency, and the primary purpose was it to support international trade in goods and services. But like like some of the other financial markets we've looked at, particularly in the derivatives market, the purpose has changed over time, and it's fair to say that currently the amount of trading in the foreign exchange market to support the trade in goods and services is quite trivial compared to the total volume. And I showed you this graph here yesterday. These are actually piles of dollars, or it doesn't look like it. And this is the turnover, daily turnover in some of these markets, and in the foreign exchange market, which is by far the largest market, financial market in terms of turnover, there's about $5.3 trillion traded in the financial markets, the foreign exchange markets, on a daily basis. And we can compare that to the goods and services, together 16 trillion per year, that's annual, trade in goods, and another 12.5 trillion in services, for around about $29 trillion in goods and services traded per year, versus about 5.3 trillion per day. And if you worked it out on an annual basis, it's well over $1 trillion, not a trillion, well over $2 quadrillion trading per day, per year in the foreign exchange market. So the vast majority of trading in this market, well above 90%, has nothing to do with the trade in goods and services, has nothing to do with long-term investments. It all has to do with trading currencies to try to make a profit from the movement in the exchange rates. So that's a far cry from where the whole thing started, but that is the direction that it has developed in over time. So when we started to look at the quotations in the markets themselves, there was two ways they can be done, what we call a direct quote and an indirect quote. Both of them have two currencies, because you always have an exchange rate with two currencies. The first one is known as the base currency, and the second one is the terms currency. And if you have what's called a direct quote, if say, we take it, say, example, in terms of New Zealand dollars, it answers the question, how many New Zealand dollars does it take to buy a unit of the foreign currency? So, for example, if it was New Zealand dollars versus euros, you might have something like about 1.7 New Zealand dollars to buy a single euro. The other way you might find a quote is the indirect quote, and that's the type that we tend to use in New Zealand, which answers the question, how much will my 1 New Zealand dollar buy of the foreign currency? And so if you went New Zealand dollar versus the euro, you might find it somewhere around about 0.6 or something like that. So that means that 1 New Zealand dollar will buy 0.6 of a euro. And the good thing about the indirect one, which we use, is when you look at the exchange rates, and they fluctuate. When the numbers get bigger, that means our domestic currency is becoming more valuable. And as those numbers get smaller, our domestic currency is losing value. The other thing we did briefly cover, and we'll look at a little bit more, is that most currencies, well, not most currencies, if you look at the currencies which account for the greatest proportion of the economic output of the world, most of those are floating rates. And so what's happening in those markets is simply the traders are trading there, and there's some balance between supply and demand, and the exchange rate is simply set by supply and demand. Now, there's plenty of currencies where that's not allowed to take place, but in the currencies like we have here in New Zealand, Australia, United States, virtually all the European currencies, Great Britain, Canada, those sorts of ones, the exchange rate is simply set by whatever trading is taking place in the market. So this brings us to the point of how these markets, how they actually work. So I'm going to put up, this is a little bit out of date, and I'll point out where it's out of date, but we'll put it up. So this is a map of the world color-coded by the type of exchange rate regime a country has. Now, if we go back far enough, and you don't have to go back too far in history, pre-1971, everything was fixed at that point. And then one by one, nations went and changed from having a fixed currency exchange rate to some sort of other one. And for most of the developed world, they now have a floating exchange rate. So the dark greens, like here's Australia, there's New Zealand, which you can hardly see, Brazil, Mexico, United States, Canada, virtually all of Europe, Great Britain, they're all on a floating rate exchange system. So basically, the exchange rate simply moves around in response to whatever market forces there may be. But there's some other colors there. Like the next one on this list is the managed float. And it says an exchange rate that's allowed to float. Okay, so it does float, but they have a set band for it. And so they don't let the thing move totally as it would like. So if it sits in that band, they won't do anything. But if it starts to move towards the outside of the band, either high or low, then they will intervene, and usually the central bank will intervene on behalf of the government to bring it back into the band they want. And that's these light-colored ones. So, for example, here's Russia, a number of the Eastern European countries, significant number of them in Africa, Asian countries, a number here in South America, are on a managed float. Okay, so they're allowed to float, but if they move too far, typically their central bank intervenes to try to bring it back into a band that they like it. Now, the crawling pig is another one. That's why this thing's a little bit out of date, because the blues are here, like here's China, Mongolia, Saudi Arabia, and so on, a number of African currencies, some South American ones. They're on a pegged exchange rate. So their exchange rate is actually pegged against another currency. The typical one is to peg it against US dollars, and you fixed your exchange rate. Now, China has moved away from having a pegged exchange rate, and they're using the thing that we call a crawling peg. And even in the crawling peg, they're probably a bit closer to the managed float than the crawling one. But they're essentially set the band, but then after a while, with a crawling peg, you simply take your band and you move it. And so when they started to do this, everybody thought that once China did this, that their exchange rate would move up, and because they were nasty currency manipulators who kept it artificially low, but once they let it go, it started to go down by itself, which was unexpected. And so China is classified as using a crawling peg, but you can see throughout the world there's a lot of currencies which are not floating freely. They're actually pegged at a specific exchange rate to another currency, and as that currency moves with respect to other currencies, then their own one will. For example, if you take Hong Kong dollars, they're pegged to the US dollar, and as the US dollar rises and falls against other currencies, the Hong Kong dollar simply moves with it. So if the US dollar moves up, the Hong Kong dollar moves up. US moves down, Hong Kong simply follows it. It's because it's pegged at a fixed exchange rate. And they have all their disadvantages and advantages. There's a few red ones in there. Red countries like, Ecuador's here. And the red ones are countries which do not have their own domestic currency. They actually use the currency of another country. And so what happens, for example, with Ecuador is because they are using another currency altogether, there's no Ecuadorian peso or anything like that, as that other country's currency moves, then essentially their exchange rate simply moves along with it because it's pegged. It is using another currency. In this case, Ecuador is actually using the US dollar. So whatever the US dollar does relative to its trading partners, its exchange rate moves because they don't have an independent currency. So any question on that bit before we move on? Okay. So coming back to this point is that the foreign exchange markets are large, and there's a lot of trading going on. In the New Zealand market, you know, this is 2016 figures, about $10.6 billion traded locally. But when you include the rest of the world, New Zealand dollars are traded, of course, not only in New Zealand, but many other places. We're up about $145 billion per day in trading in these markets. So the primary function, or maybe the original economic function of it, to support trade in goods and services is simply passed into history, and maybe about 2% of all trading in the foreign exchange markets is there to support the trade in goods and services. Everything else is for some other purpose. So if you want to trade in these markets, how do you trade? How is it conducted? If you want to trade, well, who do you do? Who do you trade with? You go to exchange, dealer, something else? Yeah, they're all dealer markets. So if you want to trade, sometimes it's completely automatic. If you use your credit card, they'll simply handle it for you. If you want to actually talk to someone, you will talk directly to the dealer who will sell you or buy from you the currency you have. And in most cases, in most of the commercial banks are the major dealers. And so what they will have on their balance sheet is that they will have a whole range of foreign currencies to meet the needs of their customers. And if you buy that foreign currency from them, they take the currency they own and they sell it to you. And conversely, if you sell them some, they take it into their inventory, and that becomes part of their assets on their balance sheet. So if you wanted to hedge, say you're an exporter or an importer and you want to hedge a foreign exchange risk, what's your main tool if you actually want to hedge it rather than speculate? A future is that if you want a futures, you would go to an exchange market. And what we find in the futures market, like I say, is that typically the position gets closed out. It's never carried through to the end. And so people who are trading in the futures market in general are not trading there to hedge. They're trading there for other reasons. Okay. But you can use the futures market to hedge. Anything else that you could use? That's actually, that's essentially a security that is being created to deal with foreign trade. And there is a sense that you can actually use that to hedge. Yeah. Okay. Any others? The other one, the one that is used probably most often if you want to hedge, is to actually go and talk to your bank about a forward contract. Now, we talked about forward contracts in the derivatives section, so this is simply a repeat of that. But it turns out that, in this particular market, approximately 90% or more of forward contracts result in delivery. And what we find is that people who have a genuine need to hedge either, if you're an exporter, they've got to get receivables. The importers, they have to pay. If they want to hedge, typically they will use a forward because they can go to a dealer and they can simply customize it both in terms of how much and in terms of dollars or yen or whatever it is, and the dates to match exactly what they have. So they can basically, with a forward, eliminate all their forward exchange risk. So if you actually go to a dealer like a bank, not only do they have a rate which they'll sell to you today, typically they'll have a range of rates over a number of periods you can simply look up. But then if you want to customize them, you can talk to the dealer and get the custom rate for the particular day. Okay, any questions before we move on to the balance of payments? Oh, no, put your hand down. It's okay. Okay, balance of payments. What is a balance of payments? You might have met this in another economics course. Anybody come across a balance of payments? Okay, so it's a record of the imports and the exports, both in terms of goods and services, and there's some other odds and sods in there. And so basically, it simply adds up how much you earned and how much you spent, and it turns out whether you're in balance or not. Okay, so unfortunately, most countries in the world are not in balance, and so we actually split this thing into at least two pieces. So what's a current account? When we talk about a current account, which is part of the balance of payments, what's the current account? Payment within a year. Okay, so it's not actually to do with the length of time until payment. So let's flip over. So the current account is the one that records the flows of goods and services. So if there's goods and services, and transfers are slightly different, we'll come to what that is. Like, for example, if an importer is buying cars from Japan, they're coming in and they're paying for them, that goes in the current accounts. If you're buying insurance from an insurance company overseas, that goes into the current account. So it is the flow of money in response to the importing and exporting of goods and services. Now, the transfer payments, transfer payments are slightly different in that there is a movement of money, but there is no corresponding good or service associated with it. And two clear examples where this happens. If New Zealand, say, for example, gave foreign aid to a country, there is a flow of money from New Zealand to the other country, but there is no goods and services traded. So that is a transfer payment. And the other common one is, like, for example, a number of Pacific Islanders have come to New Zealand to work, specifically to send money home to their families. So they get a visa, work visa, come to New Zealand, they work, and they send money home to their family. And you can see, in that particular case, that there's a movement of money, but there's no corresponding movement of goods or services. And those go in the current account, and they're simply referred to as a transfer payment. Now, the other one, the other main bit, because I've sort of got a couple of gray ones down there, is the financial or sometimes known as the capital account. And that's basically a movement of money for the purposes of investing or making loans. And so if people move money to New Zealand, say, to buy shares or buy a farm or something like that, that type of movement of money will go into the capital account. And the basic thing here is that changes in your current account balance, okay, if you're in surplus, then it's got to be offset by changes in the capital account. So if you have a surplus, that means you have more money coming in from your current accounts than you're spending on goods and services overseas, but that has to balance by the capital account where that money's got to go back out again. And so that's simply a matter of bookkeeping. You have a surplus in one, then you have to have a deficit in the other. Now, there is this one down here, the statistical discrepancy account, which is, these things, it's kind of hard to add them all up. And if you get mistakes, then you simply shove them in there. If we take the capital account, okay, so that's just this one here, we start breaking it down. There's several different pieces to it, but they're all, when you see them, they're all basically movement of money to make investments of various types. So, for example, the first one, short-term investments, less than a year. Basically, these are money market investments, short-term investments. The things we call a portfolio investment, anything greater than a year. Typically, you can trade these things on a market. So if they're buying shares or they're buying bonds, typically it can be traded on the market, and so they're considered a portfolio investment. And then the third one, the direct foreign investment, is that where you buy something which allows for management control. For example, if a foreigner decides to buy a dairy farm here, they buy the farm and they have a management control of that farm. And if that investment is of that type, then that's considered to be a direct foreign investment. And again, the basic problem here is that if you have a surplus in your capital account, then that's got to be offset with a deficit in the current account. And that's just a matter of bookkeeping. And when if we ask the question, you think about what that exchange rate is supposed to do, where it came from, to support international trade in goods and services, what we want this exchange rate to do is to move in such a way that it brings our trade back into balance. Now, in most cases in the world, that doesn't happen. Trade is not in balance. And you ask, well, why does it never come back into balance? And it's this problem here is that the movement for purpose of investment is the strong movement. This is the one that actually tends to drive the exchange rate. If we break the things that might affect that exchange rate, one is trade might change the exchange rate. Second thing, movement of money for the purpose of investment might move the exchange rate. The third thing that might move the exchange rate is all those crazy traders. They're just trading like crazy out there. Maybe they might move it. If you ask, well, of these three, which one really drives it? It's the movement of money for the purpose of investment. That's the thing that tends to drive it. And so if we think, oh, we'd like our exchange rate to move in such a way that brings this trade back into balance, it doesn't happen because of the flow of money for the purpose of investment. So even though we may be running a trade deficit, as long as we're considered to be a nice place to invest, there may be a strong flow of money to come in for investment purposes, and that will offset any tendency for the currency to move to bring trade back into balance. So here's our hope. Well, no, this is what actually happens. Okay? If we have a current account deficit, there's no free lunch in this world. You've got to get the money from somewhere. You have to have money coming in. Either you borrow from overseas, and we do plenty of that, or we sell assets to them, like dairy farms, and forests, and power companies. If it's the other way around, say we had a surplus, that money has to be offset by an outflow. In that case, we could make loans to overseas, and we could run off and buy overseas assets. And that's just a matter of how that system works. So hang on, I think I might pop ahead here. Oh, way ahead. No. Okay, I'll leave that. But bear that in mind. Where are we going? Bear that in mind, because we'll come back to this point. It's further away than I thought it was. Anyway, anyone want to ask a question on that before we move on? Okay, very nice. Right, moving on. So international trade and exchange rates. How do the following aspects of international trade affect exchange rates? Okay, first up, how would relative prices of similar or identical goods affect trade and affect an exchange rate? Let's take an example, say for New Zealand, we produce lots of dairy products. Let's take butter as an example. How would the relative differences in price between butter in New Zealand and butter overseas affect trade? And then how would that trade affect the exchange rate? Yeah, go ahead.
If the domestic good has a higher, let's say a higher price, like in proportion to a good overseas, then basically what's going to happen is that we're going to want to buy more of the cheaper good from overseas and import it to New Zealand. And so then there's strong demand for the New Zealand dollar, and so that would push exchange rates up, and then vice versa. Let's say we could do a good for really, really cheap, but overseas they paid a nice high price for it. Well, then we want to receive that nice high price, so we'll export it, and then with all of our foreign currencies that we've received, we'll bring it back to New Zealand. And basically, you want high demand for something.
That's all right. That's right. So the basic principle is, if you're free to trade and the thing is tradable, you'll buy where it's cheapest. And so if the domestic good or service is more expensive than one overseas, you'd be inclined to import. And similarly, the other way around, if it's, you can export if your domestic product was cheaper. Like, for example, butter was cheaper here than it is, say, in the United Kingdom. Then people would try to buy our butter and take it over there because it's cheaper. Now, what we hope in terms of the exchange rate is if we, and this, in one sense, it's always working against us if it works out like it's supposed to. If we have an advantage in a certain area like that, we want the exchange rate to move in such a way as to take that advantage away. So if our goods are cheap, what we want is our exchange rate to move up to bring us back into balance. So relative prices is one thing. What about trade barriers? Of course, the world's not perfect. What about a trade barrier? How would that affect things? Yeah, go ahead.
Well, like quotas or tariffs and similar things, they would influence or artificially influence demand and supply. So like the demand and supply of those goods could transfer over to like how much you demand with that currency if you are dealing with it.
Okay. Yeah, so a barrier of any sort, like a tariff or a quota or something like that, stops the flow of goods and services. And so the exchange rate may not move in the direction we would like. And simply, because there's something that stops it. What about the last one, resource endowments? How would that, what are they? How would it affect the exchange rate over the long term? Yeah.
So, like, for example, Africa has the diamond mine, so it's going to, like, currently they have an advantage compared to New Zealand or Australia. So it's just help them to kind of more investment as well as like export, helping with the export.
Yeah. So if you have a resource endowment of some sort, and South African diamonds are a really good example. There's major diamond deposits there, and so they have a major source of diamonds which the rest of the world simply doesn't have. And so that tends to mean that if you want to buy them, you want to buy a diamond, want to get married, want to give your girlfriend an engagement ring, you give a South African diamond. And that tends to, of course, mean that there is a demand for that currency. And again, what we're hoping will happen is that it will move the exchange rate in such a way as to cancel out the advantage that they have. If you look at another example of where there's an advantage, New Zealand has moderate temperatures and pretty much year-round rainfall. Many places don't have that. Either they don't have year-round rainfall or they have extremes of temperature, which makes New Zealand a good place to farm, and so that gives an advantage. But we hope, in terms of our structure of the world, that the exchange rate will move in such a way as to cancel that advantage out and make things nice and balanced. So, let's see, yep. Sometimes, this one here tastes, again, sometimes things will simply change. What people think is a good idea will change. The oil shocks of the 1970s, although a long time ago, are a very good example of this. Like, when I was a kid in the United States, we had a 7-liter V8 car, so you put the gas in and it's gone. And so the oil shocks came along, and suddenly people thought, oh man, 7-liter V8s just aren't a good idea because they just drink too much gas. And so there was a sudden move, and it was very quick, that people said, oh, I like little small cars, little compacts. And the thing that happened was that the U.S. manufacturers, U.S. manufacturers, slow off the mark. They didn't respond to this demand change. But Japan was able to do it, and very quickly, Japan was exporting over 2 million cars per year into the U.S. And of course, what we hope will happen is, okay, they got an advantage, they got off the block fast. We hope that the exchange rate will move in such a way that will cancel that out. Another one down here, productivity. Again, if you think about what's going to happen, if we have an advantage because we have some sort of higher productivity, hopefully that'll lead to higher economic growth, greater demand for goods and currency, but ultimately what we hope is that the exchange rate moves up to cancel out that advantage. So whatever advantage we have, however we have it, what we're hoping is that our exchange rate is going to move to cancel it out so that trade is balanced. Okay, any questions on that before we move on further? Okay, moving on. So theories of exchange rate, these aren't really like theories, these are just good ideas. What's the purchasing power theory of the exchange rate? just one of several theories. What's the purchasing power parity theory of exchange rates? Yep.
It's the, for example, like for the barter, that the price in New Zealand is supposed to be equal to the Australian, just in terms of the exchange rate.
Yeah, so taking that idea, if you take what are either identical, and for example, a half kilo block of butter pretty much is half kilo block of butter no matter where you are in the world, the purchasing power theory of exchange rates essentially says that if you have these identical goods across the world, by the time you take the domestic currency, do the foreign exchange translation, then they should be the same price. So half kilo block of butter in Australia, after adjusting for the exchange rate, should be identical in price to the New Zealand one. Same with Great Britain, same with the US. And basically, it's quite an attractive idea because you think, well, why would something be more expensive elsewhere, particularly if there's no trade barriers? So the idea is quite attractive, but why might it not work? Why might it not work? If we have two identical goods, yep, why might it not work?
Part of it being flat labour's been used to produce it. So, for example, because if you look at things like, especially if you go to like a Southeast Asian country, and food will be a lot cheaper than it is here, and that's obviously not exactly like supporting.
Yeah. So the key point about that one is, like you talk about like food in general, is that a number of things aren't even tradable because they spoil, and so anything that makes them like non-tradable, like for example a restaurant meal. I mean, obviously labor costs in New Zealand are much higher than in many Southeast Asian countries, and so a restaurant meal costs more than there, and that's simply because you can't trade that stuff. So there's various reasons why it may not hold. I mean, some of the other we talked about just a few minutes ago was if there are specific barriers, tariffs, quotas, and so on. If there are barriers like that, then this thing may not hold. Okay, let's move on a little bit. Yep, said that, but more one price. Okay, yeah, about the inflation. If you've got a high inflation rate in your country, then that's going to drive up your prices. And what will happen over time, we hope, is that the currency will depreciate in order to offset that. So high inflation hopefully leads to depreciation in your currency. Again, what we're doing there, what we're hoping for, is that the movement in the exchange rate will cancel out any advantage or disadvantage that a country may have. Now this thing here, I couldn't get one. I tried to get one more recent than this, but this is the most recent one I have. This is a Big Mac index. If you go to the website of The Economist magazine, you can find this thing, the Big Mac index. They've been producing this index since the mid-1980s, I think 1986 when they started. And the idea was to try to take the purchasing power parity theory and apply it to McDonald's hamburgers. Because basically, it doesn't matter where you are in the world, if you go into McDonald's, their food looks pretty much the same no matter where you are. And so although it doesn't actually meet the requirements of the model, because basically Big Macs aren't tradable, what they tried to do was say, what's the price of the Big Mac in a particular country, do the exchange rate calculation, and we'll compare it to the United States where it all started. And so what we have in this great list here is a bunch of countries. You probably can't read them very well, but right at the top there, there's the United States along this line here. And from there on down, after you do the exchange rate calculation, the Big Mac is cheaper in these countries than it is in the United States. And in those few up there, the Big Mac is more expensive than it is in the United States. Up the top there is Switzerland, which is about 30% more expensive to buy a Big Mac in Switzerland than the US. And New Zealand is here, and here's New Zealand, and we're almost 20% cheaper. Now, the idea when they started this, it was a bit of a joke. But it's sort of become a bit more serious, and there's even been academic papers written about it. But it tried to actually take this idea of the purchasing power parity theory and apply it to this thing which is standard across many different countries. And what we do see is in most places in the world, the Big Mac is actually cheaper overseas than it is in the United States. And what they tried to do is try to use this to predict what would happen to the exchange rate. Because remember, if we go back to the basic theory, low inflation or lower prices tends to move the country's currency up. So what they were trying to look at was, if you're down in this part of the world, this piece down here, does over the long period of time, does the exchange rate move up in the way that the purchasing power parity theory suggests it ought to? Now, why might it not work for this case? Why might that not work for Big Macs? Yeah?
Because they're not representative of overall prices.
Okay, so one thing is just one item. So when you think about trade, you got to think across the entire spectrum of what's being traded. So, okay, it's a narrow little thing. That's one reason why it might not work. Yeah, go ahead.
As well as the labor costs?
Yeah, labor costs, and the key thing about the labor costs is that these things can't be traded. Like, you can't make, let's say, for example, you can't make Big Macs in Ukraine for cheap and sell them in Switzerland, okay? Because they're expensive in Switzerland, you simply can't do that because you simply can't get in there fast enough. And so the fact that you can't trade these things means that it might not work for Big Macs. Yeah, any other ideas?
Well, in terms of this, labor costs in terms of actually making it.
Yeah.
In terms of, you've actually got to serve it and all of those things as well. And so I think that's also the main difficulty is that, at the service point, so the burgers all made, the ingredients has already been put together, but, at the service after that point, you can't really change what price you have to pay for workers.
Yeah, okay, so you can't pay, just because in Ukraine, you pay Ukrainian rates, you don't pay Swiss rates for your workers. And basically, you can't really change that. Yeah, so again, that really does come down to the fact that you can't trade this. So you can't sort of import workers from the Ukraine into Switzerland and make them and pay them less. It just, there are laws against that sort of stuff. So although it's been going and still going, you can actually go to the website and look it up. It's been going for over 30 years now, and people have continued to study this thing. It's an interesting idea, the Big Mac Index, but there are some clear different reasons why we expect this may not be a good way to look at the purchasing power parity theory of exchange rate. But anyway, and here's the bonus for you. There's a question on this in the final exam, okay, in terms of the foreign exchange stuff. It's based around the Big Mac Index, and it allows you to talk about what you know about exchange rates and why they work and how they move. So don't, even though it looks like a bit of a joke, in some ways it is a bit of a joke, make sure you understand it before we get to the end of the course. Okay, any other questions before we move on? Right, moving on. Now, what about this other one? Okay, this is the interest rate parity theory. What is this theory? Anyone come across this theory? I know it is covered in some other economics courses. Anyone come across it? Know what it is? Know how it works? All very fun. Okay, so let's take an example. And when you think about this one, remember back when we looked at the forward exchange rate, and I gave you some numbers of foreign exchange rates, and there was a spot, and then there was 1 month, 3 months, and so on out in the future, and they systematically changed over time. And I said we'd get to the point where we would explain how they actually calculate those forward rates. Now, they calculate the forward rates based on this theory. Okay, so this is how forward rates are calculated. So what we'll do is we'll take an example, a simple example, and we'll show how this thing would actually work in practice. So let's say, for example, here's you got a New Zealand dollar, and you want to invest it, and you have two options open to you. One is you can invest it domestically. So you go down to the bank, put your money in, and let's say, for example, you know, for every dollar you can invest, let's say for a 1-year investment, you can get 4%. So at the end of that year, for every dollar invested, you would have $1.04 at the end of it. That's fairly straightforward. And let's say in this world you have, the other option that you have is to put it over in Australia for a year. So let's make it nice and easy, make the exchange rate 1. So you can change your thing over into Australian dollars and make the exchange rate 1. And that means you get an Australian dollar. And now you make pretty much identical investment in Australia as the alternative. And let's say over in Australia, instead of getting 4%, you only get 3%. So you get your 3% for a year, and you end out there with $1.03. Now, of course, that's Australian dollars. You want New Zealand dollars. So you have to bring it home again. Bring it back home. At the moment, we don't know what the exchange rate is. Now, the interest rate parity theories, the basic idea is that, like the idea we met before, if you have 2 or more investment pathways to a particular destination, you want them to arrive with exactly the same amount of money. So the exchange rate that we need at the end of this investment is one that will take $1.03 Australian and turn it into $1.04 New Zealand. So you start out with $1. If you invest domestically, you end up at $1.04. If you put it over in Australia and invested it in Australia for a year and then moved it back, you want to end up at $1.04. Okay? 2 different pathways, but we want to arrive at exactly the same point. So that allows us to figure out what the exchange rate has to be in the future. Okay? So if you think about it, 1 Australian dollar used to buy 1 New Zealand dollar. And that was the exchange rate up there. Now we have $1.03 Australian, and it needs to buy $1.04 in New Zealand. That's that one there. And so the exchange rate in this particular case, there's your $1.04 New Zealand, there's your $1.03 Australian, and so the exchange rate has now got to be 9.7, okay, to 4 decimal places. And so what we've seen is the AUD, you know, this is the low interest country, lower interest, and it appreciated against the NZ dollar, which is the high interest country. And this is actually how they set the rates in the forward market. And so when you ask them, well, what interest rate do they actually use? Well, they'll go and look up whatever the appropriate risk-free rate is. So hopefully there'll be an appropriate government security, say, for example, a 1-year bond or a 1-year treasury note of some sort. And if they're going to calculate what the forward rate is going to be, they would look up the risk-free rate in New Zealand for 1 year. They look up the risk-free rate in Australia for 1 year. And they would then calculate what the forward exchange rate was going to be. And so if you're hedging, and you think, well, how on earth do they figure out what that rate should be for, you know, a hedging a year in advance or 6 months in advance or whatever it may be, how they figure that out, this is how they do it. It's simply based on this idea that 2 investment pathways should end up at the same destination. Okay, any question on that before we move on? Yeah, go ahead.
How does the
Well, the thing is, if you're thinking of like setting that forward rate, if you set it any other way, then there's an opportunity to set up an arbitrage. So if for example, you think, oh, it's not going to end up at 1.097, I'm looking in my crystal ball and I think it's going to be different, and you try to set it differently, people can set up a completely riskless transaction which will profit out of the fact that you've set it wrong. And it's one of those strange things that even like for example, like when New Zealand dollars was rising for years on end, because it was a high interest rate currency, they still had to set these forward rates the other way, because if they didn't do that, then someone could arbitrage. Very, very easy to set up an arbitrage if they set the forward rate any other way. And if you go on and do some more finance, you'll learn more about arbitrage, particularly in 312, the derivatives course. And they talk about arbitrage pricing. And the other one is 331. They talk about arbitrage pricing there as well. But anyway, the idea is comparatively simple, and this is how it's actually done in setting that forward rate. Okay, any other questions? Yeah, go ahead.
I think that this theory even dodgier than the previous one.
Dodgier than the previous one.
You see that you just told us before that there's quite a lot of different countries that have a different operation of foreign exchange market, and they apparently this one is totally unreliable. Like for example, if you consider this Australia against Chinese yuan or something like that, then that's totally different policies here.
Yeah, the thing with these things is, like, when you look at it, you think, well, this makes sense, and you go and look at the real world, and the real world works the opposite way to what this theory suggests. And what we find is that the high interest rate currency appreciates, and low interest rate one depreciates. And so it's better not to actually hedge in one sense if that's what's happening. But you have to actually set the forward rate this way. The other reason why this is in here, because it's not in the textbook, is that if you're going to do the International Finance course at third year, which I think is 334, the guy who teaches that course wanted you people to know this theory before you arrive in this course, because that forms an important part of international finance. But the thing is, like many of these theories, it has extremely poor explanatory power in the real world. The only place where it actually works is basically in that forward market, where you have to do this, otherwise someone will take out an arbitrage and make money off you. So but there's a thing for making an exchange. Where are we at? Let's go on. Trade-weighted indices. The trade-weighted index is something that many countries have them. Basically, you measure your currency instead of against a single currency, is against a group of them. And New Zealand has one up until this time here, December 2014. It was against 5 currencies. It's now against the 17 largest trading partners. And this is where it's been over the last 25 years. And you can see, when you look at this, the trade weight index is the red one. It's been under 50 and above 80. So the currency swings around a lot. That's like a 60%, more than 60% swing in the currency over that time period. And the blue one is the US dollar. And you can see, because the US dollar accounts for about 30% of our trade, it tends to, the trade weighted index tends to simply follow along. Okay, so we'll end at that point, and we'll start this point on Friday. If you want to ask any questions, be around for a while. Otherwise, we'll pick this up and hopefully finish this on Friday.
encountered some of these entries and stuff?
Actually, often what you'll find is there are some specialist foreign exchange dealers that can do it cheaper. The other quite good is like if you come to a stockbroker, they can often get you a much better rate than the bank can. Yeah, and then again, like for example, some of the investment banks that have a stockbroking arm, they can get you a much better rate than the bank will give you.
It's not a lot.
Yeah,
I'm working on something, but yeah.
yeah.
So, what about you converted it to gold over there and
And,
bought it back?
yeah.
Is that
Actually, I don't know whether that'd be a good idea or not. Yeah, interesting thought. I don't know. I don't know that one.
I'm just wondering with the purchasing parity rule, it seems like it has a lot of holes. So would the general consensus be that it doesn't, it's a good theory, but it doesn't really work?
Yeah, a lot of these theories, they're like, they, in one sense, it's not like the theory of gravity.
Yeah.
Is that there? If you're trying to think about what might happen to the exchange rate, and you're thinking of fundamental forces that drive the exchange rate, then some of these ideas are useful, but none of them have much explanatory power. Because when you think about, when we talk about the three drivers, it might be due to trade, it might be due to investment flows, it might be due to all these people trading. The one that tends to drive it is the investment flows, and that really comes down to political stability and what sort of returns you expect. So it's a risk-return trade-off type problem, and that seems to be the one that drives the exchange rate. Like for example, many people say that New Zealand dollar has been overvalued, but it's been overvalued for years and years and years and years. And the reason is because we have a stable government, and so that makes the risks of investing here low compared to many other countries.
Because the one thing I couldn't get past with the purchasing power thing is, well, like a lot of companies like segment based on like elasticity. So if say the Big Mac thing, if in one country the demand for Big Macs is really inelastic, then they'll price way higher there, and I don't see how that's related to exchange rates. But
Yeah, well, I mean, the Big Mac index, I mean, it really did start off as a joke.
yeah.
But it's something that people became interested in, and it's been kept going for all that length of time, over 30 years, because a lot of people, it's something that, people look at and they can actually understand it, whereas you try to explain the theory in a bit more detail, people get lost. And it does a little bit sometimes show that the arguments that people make that certain currencies are undervalued relative to others, that there is some merit in those arguments. And you think, like, for example, the United States, why does the United States have such a high exchange rate when it runs an enormous trade deficit and has an enormous government deficit? And the perception is that it's a safe place to put money. And so money tends to flow out of developing countries towards the U.S., and that tends to push the exchange rate up. And that's the exact opposite of what you expect based on something like purchasing power parity theory.